Hello traders, welcome back to the channel. Take a look at these two figures. Can you identify what these are? Write down your answers in the comment section. So the first figure represents a price gap or vacuum block, while the other one shows a volume imbalance. We have already learned in detail about vacuum blocks. So in this episode, we will focus on volume imbalances. It is a subtle but a very powerful concept that helps understand where institutional orders may have caused inefficiencies in the price delivery. It is a visible inefficiency in trading volume between buyers and sellers, often identified by aggressive buying or selling within a short time. The market often revisits these imbalanced areas, using them as critical support and resistance levels that influence future price behavior. Price often reacts at these levels, which indicate accumulation of orders. And these areas or zones are typically used by smart money traders to identify potential entry and reaction points. So, in this video, I will talk about volume imbalances, its significance in trading, and I will also provide actionable strategies to leverage this concept for improving your trading outcome. So, without wasting any more time, let's get started. In the market, gaps and volume imbalances are key indicators of market inefficiencies. These two concepts revolve around the key notion of SMC concepts that markets are driven by institutional order flow and it is constantly moving between states of balance and imbalance. And as you may all know, a gap or vacuum block represents a price area on chart where little or no trading activity has occurred. In candlestick terms, it is an area between the closing price of one candlestick and the opening price of another candlestick. But for practical purposes, we will only consider the highs and lows of two consecutive candles. These gaps are a result of sharp price movements, low liquidity, and order imbalance. And one such gap formation is the volume imbalance. A volume imbalance occurs when there is a distinct separation between the bodies of two consecutive candles on a chart with no visible overlap between them. What this means is that the wicks of these candles may or may not intersect, but the candle bodies themselves do not touch. This separation represents a gap in price action, signaling that the market did not efficiently deliver the price between these 2 points. This creates a volume imbalance, or it is also known as a micro fair value gap. The formation of such gaps in charts can be attributed to various market conditions. For instance, the market may close for the weekend and reopen with a gap due to new information or developments that occurred during the weekend. Other than that, sudden and unexpected market movements such as economic announcements, geopolitical developments, or even large institutional trades can lead to rapid price movements, creating such gaps. But inefficiencies such as volume imbalances are not like these traditional gaps or vacuum blocks. These imbalances are also found within live price action and it happens during rapid delivery phases. These imbalance zones are the areas where the buy and sell orders could not match efficiently, which in turn leaves a void in the form of body to body gap between candlesticks. Just like vacuum blocks or fair value gaps, volume imbalances play a critical role in market behavior because volume imbalance represents an inefficient delivery of price. These inefficient zones often act like magnets, attracting the price back to these areas before continuing in the intended direction. Here, the underlying idea is that the market is driven by institutional algorithm and smart money. So, price often return to these areas to fill the gap and rebalance the order flow. This means volume imbalance can either serve as a continuation area or a reversal area. But this is highly dependent on the broader market context or what the major market structure is doing. Therefore, understanding how these imbalances form and how they can influence future price movements is essential for developing a robust trading strategy. Now, let's learn to identify a volume imbalance properly. The formation of volume imbalance is slightly different from the formation of a fair value gap. In order to identify a volume imbalance correctly, we need to analyze two candles properly, unlike three candles in case of a fair value gap. Let's start with a bullish scenario. So in a bullish market scenario, the first candlestick represents the price level before the impulse move begins. We can mark the close price of this candle. For a bullish volume imbalance, the second candlestick needs to open higher than the previous candle's close, just like this. We can mark the second candle's open price. This body to body gap is our bullish volume imbalance. The opposite case is applicable for a bearish scenario. In the bearish scenario, we will closely examine the close of this first bearish candlestick. For a bearish volume imbalance, the second candlestick needs to open lower than the previous candlestick. There should be a visible body to body gap between these two candlesticks. So the key to volume imbalance is the gap between the bodies of the first and second candlestick. There is a possibility that the wicks of these two candlesticks may overlap, but the body to body separation is what defines the volume imbalance. But what is more important is understanding the context and confluence surrounding a price imbalance. While volume imbalances or other types of gaps may visually appear attractive, not all of them carry the same level of probability. So I will now be talking about high probability and low probability volume imbalances. So let's talk about high probability volume imbalances first. A high probability volume imbalance is one which is backed by supporting structures or elements from the PD array. These arrays usually include key SMC tools like order blocks, breaker blocks, fair value gaps, liquidity voids, etc. So when a volume imbalance aligns with one or more of these concepts, it implies that the imbalance is not just a random inefficiency, but it is a strategic zone where smart money has participated. This will significantly increase the weight of the imbalance and thereby increase the probability of the volume imbalance. For example, a volume imbalance is considered as high probability when it is aligned with any of the reference areas of a PD array, supports the current or developing institutional order flow, and it is aligned with the market structure context. On the other hand, a low probability volume imbalance exists in isolation. There may not be any significant supporting structure on its left-hand side or any surrounding context. If it is just a gap that appears in the middle of the price action without any PD array elements like order blocks, fair value gaps, or breaker blocks nearby, then it is considered as weak and it is unlikely to hold any importance for the smart money players. These low probability imbalances may simply be the result of the retail-driven volatility, short-term liquidity hunts, or structural noise in the market. Acting on such gaps without confluence can lead to poor trade entries and losses. So, the key difference between high probability and low probability volume imbalances lies in their market positioning, its alignment within the PD array, and their confluence with other SMC tools. Moving on, I will now tell you why volume imbalances matter in trading. See, a volume imbalance is not merely a visual gap on the chart. Instead, it represents a deeper understanding of the market dynamics that can significantly influence your trading decisions. So here are some of the reasons that make volume imbalances highly significant. First of all, it is very helpful in predicting market reversals. You see, volume imbalances often precede market reversals, acting as an early signal to the changes in the trend direction. The magnetic nature of these imbalances draw the price back to the key levels of supply or demand before the market reverses to continue its existing trend. So these imbalances will allow you to anticipate potential turning points in the market and thereby adjust your strategies to take advantage of these movements. The second feature is that volume imbalances can act as supports and resistances for prices. For example, if a volume imbalance serves as a support level, the price may revisit this area and then move upwards. Conversely, if it serves as a resistance, the price may struggle to break through and could potentially reverse, leading to a downward movement. But do keep in mind that this idea should not be used in isolation. Rather, you need to look for confluence setups that improve the probability of success. The third benefit is that traders can utilize volume imbalances as entry points by treating them as micro fair value gaps. Once these gaps are filled, they can reinforce the market support or resistance levels. Additionally, Volume imbalances can draw price towards them, thereby providing a clear target for price movement, which is particularly useful when exiting trades. This will result in better trade execution and higher probability. Another associated benefit of volume imbalances is that it will support your risk management. These volume imbalances can offer clear price levels for setting your stop loss orders. When a trade moves against your position, these imbalances can provide logical exit points, thereby minimizing potential losses and enhancing overall risk management. Now, let's talk about the strategy part. See, trading is not just about drawing lines and marking zones on the chart. Likewise, it is not just about spotting a fair value gap or order block on any random time frame. Trading with SMC, or in fact trading in general, is all about building a logical narrative around the market structure, liquidity, and institutional behavior. To do this effectively, you must incorporate your higher time frame bias, PD array confluence, and market structure shift across multiple timeframes. If you want to become an effective SMC trader, then using these concepts together to filter out weak setups and thereby enhancing your trade accuracy in both bullish and bearish conditions is the proper way to go about it. Always keep this in the back of your mind. So, the first and most influential thing is understanding multiple timeframes and their alignment. This involves using a top-down approach where you begin your analysis from your high timeframes. This will help you to understand the broader market context and structure. So, higher timeframes like weekly, daily, 4-hour, or even 1 hour can be used for analyzing the market structure and trend bias. Once the higher timeframe bias is set, then you can shift to your lower timeframes like 15-minute, 5-minute, or even 1-minute charts to find entry confirmations around these imbalances. But you need structural confluences for your entries. PD arrays will help provide them. When multiple elements of SMC concepts align with your higher timeframe structure and directional bias, the setup becomes high probability. For example, take a look at this bullish market scenario. I have considered this particular bullish swing leg. I have also plotted the premium and discount zones of this swing move. Here you can see a bullish volume imbalance formation. Now, if you observe closely, you can see that a bullish fair value gap sits closer to this volume imbalance inside a discount zone. There could also be situations where you can get an order block also along with a fair value gap and volume imbalance, thereby offering triple confluence like this. This particular setup constitutes an inefficiency, institutional interest, and discount pricing. This stacked alignment will give you a precise zone to take your entries from. Since volume imbalances can act as micro fair value gaps or a support level in this particular case, we expect the price to retrace back into this zone. Once price returns to this zone, you need to wait for a price action confirmation like a change of character or market structure shift on your lower time frame before taking an entry. Now, a lower time frame market structure shift can be used as a powerful confirmation tool in SMC that can present a transition in control. So in this case, we can see a transition from sellers to buyers because in the lower time frame chart, the corrective move will look like a bearish trend. The opposite is also true. A market structure shift represents the transition from buyers to sellers in a bearish scenario. So market structure shift will help you avoid taking premature entries. So in short, a higher time frame bias paired with a lower time frame bullish market structure can tell you that the market is transitioning into a delivery phase and it is ready to continue in the previous trend direction. And finally, we can place a long trade entry when the lower time frame bullish market shift happens, or you can wait till the market makes another break of structure before an entry for additional confirmation. You can set your stop loss below the lowest point before the change of character happened. Your primary target would be the next draw on liquidity, which in this case would be the previous swing high level on the higher time frame structure. This is a higher reward to risk setup. And as you can see, prices rallied higher after reacting from our zone of interest. Now, even though volume imbalances are a powerful tool, they are not completely foolproof. For consistent high probability trades, It is important to use them in conjunction with other SMC tools for better and mature trade entry and exits. These concepts work across all liquid markets, and it provides you with a structured and disciplined framework for navigating the market like smart money. So, this is all you need to know about volume imbalances. In the next episode, I will talk about inverse fair value gaps, which is a very useful entry method that smart money traders use to execute their trade positions. So, stay with us to find out. Meanwhile, if this video was informative, kindly hit the like button so that the YouTube algorithm knows that you're interested in these type of videos. If you have any doubts or suggestions, do mention it in the comment section. Also share this video with your friends and fellow traders. And if you are new to this channel or you have not yet subscribed, make sure to subscribe to help us complete the 1 million goal by the end of 2025. I will see you guys in the next episode. Till then, bye.